time, the money in your wallet is quietly losing its value. Inflation eats away at purchasing power, turning the dollars you saved yesterday into fractions of what they were worth. To protect that cash, you might move it into standard bonds. But when central banks raise interest rates to combat inflation, those traditional safe havens can trap your money. That trap is called duration risk. It is a mathematical certainty. The longer you lock up your capital in a bond, the harder its price drops when interest rates go up. The iShares 0 to 5 Year TIPS Bond ETF, ticker STIP, was built to counter both of these forces. The fund tracks an index of U.S. Treasury inflation-protected securities, strictly limiting itself to those maturing in under 5 years. By combining inflation protection with a short maturity window, the fund creates a mechanical defense against rising prices, while minimizing the damage from rising interest rates. Looking at the sector breakdown, the foundation is highly secure. Nearly 99.8% of the portfolio is held directly in U.S. Treasuries, maintaining an AA credit rating. The mechanics of these bonds are tied to the Consumer Price Index. When the CPI rises, the bond's principal amount adjusts upward. The bond pays a fixed percentage rate, but calculated against this larger principal base, actual interest payments grow alongside inflation. This creates a tax problem. The IRS taxes those upward principal adjustments as income in the year they happen, even though you do not receive the cash until the bond matures. In finance, this is known as phantom income. Holding these bonds inside an ETF structure offers a workaround. The fund converts those inflation adjustments into a monthly distribution. This gives investors the actual cash flow they need exactly when they need it, matching the tax liability month by month. It takes the complex, illiquid accounting of government debt and turns it into a manageable, predictable cash stream. Operating at this level requires immense scale and tight efficiency. The data shows a massive footprint, over $14.6 billion in net assets concentrated into just 25 specific government holdings. Running that portfolio costs almost nothing. Management fees clock in at an expense ratio of exactly 0.03%. The most critical vital sign here is effective duration. This number measures exactly how sensitive a bond's price is to shifting interest rates. The fund maintains an effective duration of 2.37 years. Because that time window is so short, the portfolio is highly insulated against rate volatility. These metrics define a vehicle optimized entirely for capital preservation, keeping costs low and liquidity high. That insulation matters deeply when the macroeconomic weather turns hostile, especially during periods of aggressive interest rate hikes and severe market volatility. This chart shows how inflation-linked assets performed during the severe rate hikes of 2022. The traditional full curve TIPS index took a massive hit, dropping nearly 12%. During that exact same period, the 0 to 5 year structure proved its worth, limiting losses to just 2.7%. The primary risk to this strategy comes when inflation cools off. In a low inflation environment, standard nominal bonds will consistently outyield TIPS, causing this fund to underperform. There is also tracking error risk. Transaction costs, uninvested cash, and shifting index rules can cause the fund's returns to drift away from the exact benchmark it follows. Ultimately, the short duration acts as a mechanical shock absorber. You trade the higher yield potential of long-term bonds for near-term stability. Measured, thoughtful realities for anyone considering this fund as a portfolio anchor. The bullish view sees a Morningstar gold-rated fortress. It is an ultra-low-cost tool that physically locks your purchasing power against inflation while dodging the worst damage of rising interest rates. The bearish view focuses on the opportunity cost. Buying this level of safety means you are deliberately sacrificing the higher yields and broader growth potential found in longer-term bonds. You are also entirely reliant on the government's Consumer Price Index. If the official CPI math fails to capture your real-world living costs, the inflation hedge is compromised. SITP is not designed to make you rich. It exists to ensure that $100 today will still buy $100 worth of value tomorrow, no matter what happens to interest rates along the way. Does a short duration anchor belong in a modern portfolio, or is the opportunity cost too high? Let us know in the comments. Carefully consider the fund's investment objectives, risk factors, and charges and expenses before investing. Investing involves risk, including possible loss of principal.